Hello, this is Steve Coker, president of Cedarstone Advisors. In this edition of Cedarstone Economic Insights, we'll be focusing on the U.S. consumer. How strong is the U.S. consumer, and what does it mean for the economy and for stocks going forward? First, let me explain why the health of the U.S. consumer is so important. Within the U.S. economy, personal consumption represents 69% of GDP, or 69% of the overall economy. So while it may be really interesting to talk about Boeing's aircraft orders or the swings in government spending, it is really the U.S. consumer that is the engine of U.S. growth. It's not an overstatement to say that as goes the health of the U.S. consumer, so goes the health of the U.S. economy. As many of you know and lived, the U.S. consumer has been on a roller coaster ride for the past 10 years. In the years running up to the 2008 crisis, the assets of U.S. households expanded rapidly, mostly fueled by the prices of homes. And that feeling of wealth resulted in increased spending as many individuals refinanced their homes over and over to fuel spending. From those bubble years, household assets collapsed due to the collapse in housing prices and stock prices. Well, here's the good news. Household assets have recovered from the pre-2008 crisis. And what is also significant is that the total value of household assets has reverted to the long-term growth trend, suggesting that the U.S. consumer is healthy, but there does not appear to be a wealth bubble like there was in 2007. There's more good news from the trend in liabilities, or debts, of U.S. households. Again, U.S. households borrowed excessively during the early 2000s, and as you can see from this chart, over the past 5 years, consumers have been paying down debt. However, also notice that in the last 2 quarters, we do see an expansion of consumer credit. Well, why is this significant? Well, you can think of consumer debt as advanced spending. If I can borrow now to buy that TV, well, then I will have to reduce spending in the future. Over the past 6 years, the U.S. consumer has been in pay down mode. Now, they appear to be in buy mode, meaning increased consumption and growth in the economy. As we look at the financial obligations of U.S. households, the U.S. consumer has never been stronger. In fact, the U.S. consumer's ability to cover fixed monthly expenses, as measured by the financial obligation ratio, has hit a record low. What this means is the consumer's ability to cover the monthly nut has never been better. Meanwhile, consumers' attitudes, as measured by the U.S. Consumer Sentiment Index, have recovered to normal. What this means is that consumers feel comfortable to spend in the current environment. We are not yet seeing irrational levels that would indicate a bubble, but merely a recovery to normal from the record lows that we saw in the 2008 crisis. So in summary, we see that assets have recovered from the bottom and reverted back to the trend line. Household debt has been paid down so that household net worth is hitting new highs. Financial obligations are at record lows, and consumer sentiment has normalized. Put it all together, and we believe that this is good news for consumer spending going forward. And while we believe that much of the good news is already baked into the price of the current stock market, it explains why stocks are fairly reasonable at these levels. I hope you have enjoyed this edition of Cedarstone Economic Insights. If you have any questions or would like to discuss any of the things that we've discussed today, please give us a call. We'd love to talk with you. Thanks so much.